Corporate finance presentation, pricing the security, and dilution. Get ready, it's time to take your chance with corporate finance. Dilution. In a situation where the company has already issued common stock is on the market, and they want to issue more common stock in order to generate capital, the issuance of the added securities can cause actual or perceived dilution of earnings for the current shareholders. In other words, if you're a current shareholder, you might be skeptical of the company issuing more stock because that would mean that there's more stock out there that owns the company that could dilute or possibly decrease the amount of earnings per share. Now, that's going to be, that perception would be the case if you don't think the company is growing. If you think that the company is growing, meaning they take the money from the added stocks that they issued and they take that money and they invest it and they're able to get basically a return on it, it might be the situation where the increase in the return is such that the earnings per share could be beneficial move for the shareholders as a whole with regards to the earnings per share. But you can see how, as a shareholder, you would be skeptical of that because as the more shares go out there, that's going to dilute the earnings and it might dilute your basically voting power and so on in the corporation as well. But again, flip side, if the company actually grows, if they take that money that they get, they invest it in a way that's going to be beneficial, and then they grow their earnings, then it could have an increase in basically the earnings per share. So we have the market stabilization. The investment banker can stabilize offerings during the distribution period by repurchasing securities when the market price goes below the initial public offering price. So they're going to try to figure out what the price should be as they issue it onto the market. Then the market's going to determine, of course, what they're willing to pay for it. And if they want to adjust it or they think the price is going down too far, then they might repurchase their own stock, taking stock off the market. Now there's going to be less out there, less supply. The less supply out there could then increase the price. A shelf offering allows a company to register a new issue with the SEC, Security and Exchange Commission, but allowing for a multiple year period to sell the offering instead of all at one time. So they have more time period in order to sell the offerings. This allows the company to adjust the timing of the sales of a new issue to take advantage of more favorable market conditions. So now they could say, without basically trying to rush through the filing, they have a longer period of time which they can sell these securities. And this could be in the case of bonds as well. And they can look for the favorable market conditions and then sell at that point in time. The company would maintain any unissued shares as treasury stock.